Different types of investments perform better under different market conditions. Investing in a variety of assets like stocks, fixed income, real estate, and gold can result in better diversification and can help reduce the risk for overall investment portfolio. In fact, one study found that how you diversify your portfolio can account for more than 90% of your investment performance. In recent years, the big stocks of the S&P 500 index have overshadowed the performance of other parts of the market, like international and REITs. This has caused some to question the benefits of diversification, which can require more oversight and cost than a low-cost, large-cap index fund. While diversification will not guarantee you the best results each year, it can help you achieve returns tailored to your financial goals over time with less expected risk. On your screen is a periodic table of investments, highlighting the performance of different kinds of assets over the last 13 calendar years. Each colored box represents a different kind of investment. For example, in 2013, small-cap growth stocks were the best performing asset class, while gold was the worst performer, losing 28% during the year. Using this data, Azzad Asset Management created 3 hypothetical portfolios to determine how different portfolios would have performed using different strategies. The first portfolio consisted of only the top performing asset classes of the prior year. For example, in 2001, small cap value stocks performed the best. So starting in 2002, the portfolio invested in only small cap value stocks. In 2002, commodities performed the best. So the following year, the portfolio invested in just commodities and so on. The second portfolio was constructed based on a contrarian strategy. In other words, to invest money in the prior year's worst asset class and expecting it would turn around the following year. The third portfolio invested equally in all the asset classes to create an equally weighted allocation or more fully diversified portfolio. We measured 2 variables, the average annual return, which is labeled simply return in green on the chart, and risk, which is shown in red. Risk is determined by calculating something called standard deviation. It's a math term that basically calculates volatility or wild swings in performance. Generally speaking, the lower the standard deviation, the lower the expected return. Here are the results of the study. The 3 hypothetical portfolios are listed horizontally along the x-axis. You'll see that portfolio 1, which invested in only the best performing asset classes from the previous year, returned 7.2% over the period, but those returns came with a fairly large amount of risk, more than 20%. Remember that portfolio 2 invested in only the worst performing asset classes, assuming they would outperform the following year. That portfolio returned only 2.4% over the period and did so with a standard deviation or risk measurement of 20.9%. Lastly, portfolio 3, which invested in all asset classes equally, outperformed the other 2 portfolios, returning 7.5%, and took on less risk, which came in at 15.4%. This study shows that a diversified asset allocation can lead to better risk-adjusted returns than other strategies, like picking the best or the worst asset classes. Diversification works similar to a rowing team. Each rower has a position and a particular skill that helps the boat move forward. Some rowers are responsible for the stability and steering, while the physically strongest rowers are responsible for propelling the boat forward. Each rower has a specific role to play in helping the team win the race. Diversification can't solve all problems, however. Generally, it won't give you the highest possible rate of return. This means your portfolio is not likely to outperform the top performing asset class of a given year. But here's the important part. No one can predict the top winner each year. Going back to the periodic table of asset classes, between 2000 and 2012, the previous year's top returning asset class repeated its top rank only 4 times. It's more important to invest across a range of asset classes to help get the best possible return with lower expected risk. Though you won't be beating the market every year, diversification can help you stay within a risk spectrum that's right for you. It can help you avoid taking bigger risks that you can handle, but still allow you to take enough risks to meet your financial goals. Through diversification, you could rebalance asset classes to account for changes in the market without treacherously trying to time the market. You can move between riskier asset classes that might offer higher return to less risky asset classes when downside protection becomes a higher priority. Think of asset classes as being different friends to lean on at different times. At Azzad, we take portfolio diversification seriously. It's one of the biggest determinants of a portfolio success. Keeping this in mind, we use a three-step approach to diversify our clients' investments in the Azzad Ethical Wrap program, the turnkey wealth management solution that invests in the 11 asset classes shown on the periodic table of investments. We first diversify our clients' portfolios across different asset classes. For example, stocks, halal fixed income securities, cash, and precious metals. Next, we spread money within different asset categories, so we don't invest in stocks as one asset class, but large and small company stocks that can perform differently. Lastly, we select portfolio money managers to manage different asset categories, each specializing in their specific strategy. Azzad offers an important extra layer of diversification by following a multi-manager strategy. Each component of the Azzad Ethical Wrap program is managed by experienced professionals who are committed to investing your money according to Azzad's ethical investment guidelines. Think of us as a coach who combines the talents of various players into a single team, getting the most out of each player. It's just one of the many ways we are looking out for our clients' interests. Thank you for watching.